Welcome everybody to another episode of Making Risk Flow. Today we're going to deep dive into the London market future and its transformation. And I'm joined by Greg Brown, one of the partners at Oxbow Partners. Many of you will know Greg. Oxbow Partners is very well known for the LMA white paper. Today we'll touch on the white papers and some of the takeaways, but also we'll discuss what has changed since the release of that white paper a few months ago. So first of all, Greg, really nice to have you. Thank you for joining today.
Thank you for the invite. I really appreciate it. Just by way of a quick addition to the background. So yes, we're a strategy advisory firm. We focus only on insurance, which we think is really important, that particularly insurance, there's a lot of nuance to the market and there's a lot of understanding of the intricacies. And we think that's important that's a core feature of what we offer our clients. And as you mentioned kindly, we've done a couple of reports in collaboration with the LMA, that very much commissioned by them, supporting them on the writing of the materials and the research. And actually, if it's okay, I might just dive in to set a bit of a scene, because obviously that's core to what we're doing here. So the two main reports we've done, it's over the last 18 months. Time flies when you're having fun. And the original report that the LMA asked us to help them write was on enhanced underwriting. And our original brief was actually, we've talked about enhanced underwriting. People are really interested in it. No one can really define what it is. So can you help us do that and then say what it means for the industry? So that was back in November of 2024 when that was released. Quickly after that point, the market was starting to say, well, what does this mean for leadership? And I'll dive in a bit in a minute. What does it mean for leadership? How does that evolve? Will we still need the lead follow part of the market? And then that led to the report that we did and launched with the LMA in February of this year, specifically on lead follow and the role of lead versus follow. So that's the context. Fantastic uptake of the report. People really seem to find them fascinating. Everyone seems to be absorbing it into their strategies. And even partners in the US maybe who have less involvement in the London market is looking at the way London market is evolving rather than necessarily just our reports and saying, actually, what does this mean for how our world is changing?
If you have to say, what are the takeaways of that? Let's start with that lead follow report from only a few months ago on the lead follow architecture. What are the takeaways from that report?
Yeah. Very similar to the enhanced underwriting report, where broadly we divided things into a couple of buckets. So one was just defining what it is. Two is saying, well, how would you describe it in more detail? What does it mean? And then third one is, well, what should people be doing as a result? For the first one, the first question was, what is a leader in the market? What is a leader in the London market? What defines leadership? And we very quickly found out that actually, leadership is not a technical thing. There are technical leaders, leader on a slip, Lloyd's lead, etc. But actually, if you're talking to people about what makes a leader, it's much qualitative than it is quantitative or specific or technical. So we defined a spectrum of leadership. In fact, all the way from true lead to follow. But I'll focus more on the leadership part a little bit. We start with what we've defined as true lead. And we've split those into two. So one of them is a leader that is a genuine full service lead. They put down big lines, they have full service wrapper around it, and a very well-known brand, product coverage. They lead a lot, there's a lot of breadth across product classes, within classes. So that's the full service lead. Another true lead is a niche lead. So they're not necessarily providing all of that service and not necessarily the line size, but within the area that they are focused on, particular segment of downstream energy maybe be an example, they are recognized for being very much the people to follow in that market. The books of business may not be enormous in that space, but people go, if they're on it, then it must be a good risk and I'm really, really want to follow them. You then get into what we call capacity lead. Capacity lead is you're a technical lead. So on a piece of paper somewhere, it says, or hopefully online nowadays, it says lead. But actually fundamentally, is anyone coming to you there's anyone coming to you and saying, well, your underwriting experience is particularly forward-thinking, you're kind of renowned for picking good risks, not really. Are you changing terms, wordings? Not really. You're up the stack a bit. That's a capacity lead, which is an important role to play, but you need to be careful about how you structure it, how you think about it. And then you have to follow a similar thing. You have portfolio followers who are respected for leading thinking in following all the way through to capacity follower. And again, they're just kind of putting money at the back of the slip. And it's a very important role, but it's a different proposition. And fundamentally, you have to invest more in time and effort to be at the front. And there's kind of less intense structural cost within the model being at the back, because this is much more about respecting other people and following them. So that's fundamentally the structure. And then we talked a bit about what are the categories of a leader. We talked about leader fees, lots of chat about that in the market. Long story short on that, there's no consensus on whether people think it's a good thing. Leaders tend to want leader fees because they get paid for them, and followers tend not to want to pay them. There's lots of the legality around that. So that's broadly what we were talking about, and setting a kind of a direction for the market in two ways. One of them is answering some questions that kind of went round and round a little bit. There's a few people in the market that just says, thank you for putting that conversation to bed, leader fees. It's like, actually, let's just not talk about it as much. And there are other aspects where people can use it strategically in terms of, okay, do I have the capabilities of a leader?
So those archetypes make a lot of sense, but I think you've explained it really well. What are the fundamental differences between them? So I assume if you're following in a given line, so if you decide you're a follower in a given line, obviously you want to follow mostly true leads rather than capacity leads, right? If you worry about risk selection, right, you want to be the one. You want to probably have a very efficient way of following true leads. Where if you're following a capacity lead, you probably want to do more underwriting and more risk selection. So what is the consensus in the industry of who is a true lead versus a capacity lead?
I think it is. I mean, it's fundamentally to do with it's interestingly, leadership is more described by how people would describe it, actually, rather than necessarily hugely objective criteria. I'd also say I don't entirely agree with your premise that if you're a follower following a capacity lead, you necessarily want to do more underwriting, because actually they're often in the capacity lead structure. There are other leaders in the chain. They're just not necessarily the Lloyd's lead, as an example. So you can look ahead, you can kind of jump over to an extent the capacity leader to say, well, actually, who is really at the front? Who is really setting the terms? Who's really in control? And do I trust what they're doing? Do I believe they're putting the right level of scrutiny into it? There's also a bit of a balance in terms of capacity leader. They do need to scrutinize the risk. It's just that they're not necessarily demonstrating leadership in sense of driving the market, driving the direction, driving what the coverage is. So I wouldn't necessarily agree with that. And then in terms of consensus, I'd love to say it's a lot more than just what people say about you. And in the report, there are criteria that we set out. There's a little questionnaire to say, actually, if you can answer these questions, you can broadly place yourself fairly as objectively as we would like. But fundamentally, I think it's that the main thing we want people to think about is that if you're saying you're a niche lead, are you really a niche lead or are you a capacity lead? Both are valid, but if you're investing for niche lead and delivering capacity lead, you're putting your effort in the wrong place. It's quite hard to hide a full service lead, because that is where you objectively provide a lot of services. It's the niche lead one where you can persuade yourself you're doing it. It's like, yes, I don't have a large lead size, but I do have leadership position. It's like, well, is that really true?
And did you find that people would rather classify themselves as true leads or niche leads rather than capacity followers?
Oh, yeah. all the time. And it was a really big debate in the various conversations that we had, say at the LMA board or in conversations like one-to-one conversation with the market. It's like, great, wonderful, thank you for this, and it's really good, and we buy into it. And some people said it's not told us a huge amount that's new, but it's really helped clarify what we were thinking. So what? I'm a capacity lead. I think I'm a niche lead. How big a problem is that? And I think in a hard market, not very relevant necessarily. Yes, you're a bit overspending here, there, and everywhere, but fundamentally, in a hard market, your expense ratio, it's much less important. And actually, I'll come back to expense ratio in a minute because I'm conscious of laser focusing too much on that. In a soft market, it does become more important. And critically, if you are investing a lot of effort into a position on that spectrum and you're not delivering that result, you will just get selected out, because what the brokers will be looking for would be looking for that leadership, and you will be pushing really hard in a direction and expecting a particular type of risk and particular type of conversation with the broker, and you won't be getting them. Whereas if you accept that you're a capacity lead, then you know where your role is, you know what you need to deliver. As I said, on the expenses side, this isn't and shouldn't be the primary reason you're looking at this is because of expenses. Because in a market like the London market, volatility can just change the game overnight. And underwriting can change the game overnight. So expenses are important, but it's not the primary or only reason for understanding where you sit.
Yeah, and actually, I agree with you. And I think I'm much more interested about the implications on the operating model for each of those archetypes. So we'll touch on that in a second. I would love to hear your thoughts on how should markets think about the different operating models, depending on how they classify themselves. But this report is only a few months old. But has anything fundamentally changed? The market is changing quite fast. What has changed since the release of it? Is there anything worthwhile noticing?
I think since the lead follow report this year in February, I forget quite when at the start. I mean, the geopolitical environment has changed dramatically in that time. And so specifically in this period of time, where people are prioritizing their time has shifted around. We're certainly seeing, depending on where people's books of business are, they've got a lot of Middle East business that directs attention in one way or the other. Lloyd has released its new strategy in that time. We're a big fan of it because it's getting ground to kind of grassroots of what the market should be about. And finally, the market has softened much more than people expected in that same period. I think I'm not entirely surprised by it. If you just track back on cycles, it's very easy for me to say I'm not an underwriter, but it feels like it's easy to underestimate how quickly things will soften, but it's taken everyone by surprise. Most people are below where they were hoping to be in terms of budgets. I think other than the first one in terms of the Middle East, most of it has just reinforced the need to be really laser focused on your proposition. To me, the biggest shift that has happened since one of the reports is since we did the original one in 2024. And in that time, we've gone from the closing stages of a hard market at the back end of 24 to headlong into a softening market into 25 and then obviously into 26. And it has really pivoted people to focus on this type of thing a lot more whilst balancing it with other strategic topics. I mean, AI is kind of embedded in it, but also has grown rapidly. So I think those things have changed. Market softening has driven facilitization. That's no surprise, but it's really rapidly grown, which is all connected to this overarching topic, but it's attacking it from different directions. So from our perspective, it's just created more interest in this. I think there are very few strategies that don't have this embedded in thinking.
So it's probably gone from, especially to your point on the 24 report, it's gone from being something that everybody would agree on, but there was less urgency to react to probably now the market context is really screaming to take action on some of your recommendations, right?
Yes. Yeah. I mean, it's entirely self-serving for me to say so, but yes, I would agree with that. If I think about the back of 24 when we were talking to people about it, so let's be clear, when the report came out, the whole market wanted to talk about it either with us or the LMA. It was absolutely hit the moment, but the market did segment much more into a couple of categories in terms of we really need to do something about it now. We can see where the world is going. We need to be aware of it, but it's less urgent for us. that has really shifted in the last 18 months. Doesn't necessarily mean everyone's doing everything about it. People are picking and choosing what they're focusing on. But it has, there's no one that isn't going, this needs to be embedded somewhere in what we're doing.
So I would love to hear more about what you just mentioned, the segmentation, the point we made earlier about operating models. First of all, can you share what's your view on what the different operating models for these categories look like? And then any examples of, you don't need to name the market, but examples of players that are actually significantly making progress in this direction.
Yeah, I'll bring a few examples to life. So if you oversimplify it a little bit, but it's a helpful simplification in terms of lead is about capability, leadership, being the first for brokers to think about when they come to the market. So that's about value add, service, quality, underwriting expertise. I mentioned that we had a list of capabilities for leadership. We've got this little circle in the report that talks about everything from broker experience to pricing to underwriting to all the way around to digital claims, etc. Basically, it's building a capability that building an operating model that delivers those capabilities, underpinned predominantly by people at the moment, with tech enabling that. Whereas follow is much more about how do I efficiently and effectively follow? In fact, in reverse order, how do I effectively and then efficiently follow leaders in the market? And the reason for that split is obviously, we talked about lead before a lot in this call. I won't go into that. It's clear that there's a capability investment there. With follow, mostly historically, those have been fairly intertwined. You certainly had some true follow players in the past, but the most obvious recent one is Key with their pure follow model as separate syndicate, now separate business from Brit. But think about how you do that efficiently and effectively to get access to the risks that you are most interested in. So there's that simplification. Actually, it becomes segmented, because if you think about leadership, it's am I doing a digital leadership where actually it's not so much about people at the underwriting point versus a people-based one? In follow, am I doing on a portfolio basis? Am I doing risk by risk like Key, or portfolio like Beazley Smart Tracker? So it's sub-segments. And if you think about people that are doing this well, there's a little bit of time will tell. So if you look at, say, the follow space, you've got Beazley Smart Tracker that have really invested over the last few years growing that business, separate syndicate. You've got the QBE, QPS, QBE Portfolio Solutions. You've got Canopius, similarly, one of the fastest growing in the last 3 years. QBE has been in the game longer. They've created a segmented model, all about writing portfolios, about cross-class underwriting, about portfolio management. There are no single-class, narrowly focused underwriting in that business. They've grown very fast. They've obviously put a lot of rigor and a lot of effort around that, and they've built the operating model around that. There's a bit of time will tell over the cycle what happens to those businesses. There are a few that are being a bit more multi-segment play. And Beazley's a reasonably good example. I know the model is slightly shifting, and obviously the future acquisition by Zurich will change things a bit, I'm sure. But they've had a very clear open market lead, kind of open market digital in their separate, or was a separate digital unit in their smart follow syndicate. So they've taken a multi-segment play. And as I said, like Key, they've taken a one-segment play, very narrowly focused. There's lots different, and some do it a bit more hidden away. There's a few carriers, and I won't mention their names, but they do the segmented model, but it's not as obvious from the outside because it's within one legal entity.
Yeah, but almost regardless of the legal entity, I imagine it's really difficult to be halfway there. So you either have that segmented model or you don't, right? Because the team, to your point, the capabilities are very different, right? In the lead capacity, you have to have the best underwriters at analyzing individual risks, defining the terms, etc. Whereas in the follow capacity, I assume you're much more looking at profitability of portfolios, analysis, right? So anywhere in between, it feels like, have you ever seen anything that works that is not either one or the other?
I think there are subtleties. It is a bit more of a spectrum than you describe it as. I think What we have seen not work is kind of side of desk type initiatives to structure, I don't know, try and run portfolios off the side of the desk, unless it's class by class and it's a slightly different play. But genuinely building a portfolio solutions business with a few people doing it 20% who also do fully open market doesn't work as well, in my view, in terms from an operating model perspective. Does it need to be a fully separate legal entity, a fully separate syndicate like a Key or a Smart Tracker? I don't think so. I think there are some of the examples I meant where it's a bit more hidden. Internally, they've created a structure where they are distinctly separate operating models. There's some economies of scale from the managing agent over the top, if we're talking Lloyd's. But fundamentally, they're in the same business. And I think that can work. But there is a real cultural aspect, which is fundamentally why Key was in a separate place with different people, was because of it's a different thing. And what you don't want is you don't want open market underwriters touching every risk if you're driving a portfolio business, because the expense ratio will kill you.
Yeah, my point was less. I don't think it requires a different legal entity, but it does require a decisive selection of who you are by line of business. Right? You need to say, okay, this line of business, we are clearly, we want to be a leader or true leader or a capacity leader, or we want to be a follower. And then defining the operating model, at least for that line of business in that way, right?
Absolutely. Yes.
Which is I would say probably 5-10 years ago, that was not the case, right? You would see many syndicates with lines where they would doing a bit of they would actually being more of a follower, but with a lead operating model.
Yeah, 100%. Yeah. And it's, I mean, again, I know you didn't mean this, but again, it's not quite as black or white in terms of you either lead or you follow. You can do. So if you look at a QPS, there'll be lines that from a distance that are exactly the same as what they're doing open market, but there's nuance to it. For others, it'd be very distinct. For others, they'll go, no, we only write portfolio business for business. We don't write open market. For some, they actually quite like the competition between the two because it hedges their bets. But you're right in terms of, I think the model previously of everything is just clumped together doesn't stack up in my view. That doesn't mean you don't find some portfolio elements within a class of business, but that just becomes an efficiency in terms of the operating model. It's actually more efficient to do it that way.
And would you agree that so if you think about almost the fundamentals of insurance, which is like you should shape your portfolio and the size of your book depending on the market cycle, right? You should be willing to shrink your book in a soft cycle, right? Because you might not find the right profitable risk, and you might want to grow it aggressively in a hard market. Would you agree that a follow operating model or approach actually is better suited for that approach of being able to grow and shrink as the market conditions change? I would assume in a lead capacity, it's much more difficult and challenging to do.
Yeah, I think theoretically, and for the most part, in practice, you're absolutely right. And I think the fact that you're writing book of business cross-class means that from an incentive perspective, the individuals in the team are not saying, well, like, I've got to grow this class because that's the class I write, and I can't be seen to shrink my book of business. Now, I'm massively oversimplifying. There'll be a lot of underwriters in the market who go, hang on a minute, I'm delighted to shrink my book in a soft market because actually that over the long term is the best play, and I've done that for years, and that I agree with. But if you think about the fundamentals, there's a lot of emotion in this market. And if you're writing things on a cross-class basis, you're absolutely right. I mean, I've talked to some of the people that we've named and others where they say, this is great. If we don't like it, with all the usual caveats about broker relationships, etc., we just switch it off. That's fine. Or just reduce our line size. That's absolutely fine. We can do that. It is harder for most to do that when you have a team that you are consciously paying to write business in that class of business that is going south.
And then you've sized the team to the size of the book. Right. So whereas in a follow capacity, there's less of a correlation between the size of the book or the line and the team of people that you need to lead it. Right. Okay. So that makes sense. So it's great to hear the kind of the progress the market is making on this going towards a clearer segmented operating model, what would you say are still things that are still brewing, things
Yeah.
that you perhaps thought would accelerate or have been accelerated by now, but they are not yet there?
So I think pure digitally traded business is one. My expectation was that it would still be brewing. We've talked about this quite a lot in our reports generally, and I'm particularly talking about corporate and specialty here. Obviously, if you look at UK personal lines, it's predominantly digital. That has grown much slower than a lot of people thought it would do. I'm not entirely surprised. There's lots of reasons in terms of if it's a pure commodity digital product. There's a lot of the time you would go, well, why would this need to come to London? If I can commoditize it and it's naturally works from a digital perspective, I could just keep it in country or fronting or however you want to organize it. There are definitely some good examples of where people have got that to work. Aegis, Opal, Atrium Gold, etc., where there's a digital aspect. There are many others. Key is digital. It's just digital follow lead. I think there were a lot of people that were worried about this kind of rising tide of digitization in terms of true underwriting digitization increasing and kind of taking everyone out of the Lloyd's market. I never thought that would happen, but it has been very slow. So that's one. Another, you can't do a podcast nowadays without talking about AI and generative AI. I remember we did a lot of work with clients when this all really kicked off in the market, start of 2024. The usual kind of people started playing around with it. CROs got stressed and shut it down. Boards said, what's your strategy? And all that type of stuff. So there's quite a lot of just helping people get their arms around it a bit. I'll be honest, I thought it would move more quickly in the first 18 months. And a reference that I give just to say that I'm not just a hype monger is with blockchain. I thought that was a irrelevance for the market, for 99% of the market at the time. And we said that. But it did move more slowly than I thought. Last year, it moved about the speed that I thought. It's now taken a real uptick in the start of 26. Does that mean that everyone's delivering huge amounts of value from it? No, we're still in POC territory. But now is a time that if you're watching and waiting and hoping that you can just kind of ride it out for another year and a half without having done anything about it, we're seeing people genuinely shifting, taking a real big shift in their approach and level of investment, both of people and of money in that space, fundamentally because the models are at a point where they are no longer a novelty toy.
Got it. And we've touched on the softening market. Are there any other context variables that are impacting, well, both how the market is moving, but also the speed at which it's moving?
Yeah. We talked about facilitization. That has grown very, very fast in the last 12 months. As I said at the start, it's a common feature of a softening market. You would expect to see it. I think people are seeing it grow faster than they have before. I think that's just partly because of the nature of the market and the digitization and the appetite for data. It's less purely just about an efficiency play from kind of client to broker to underwriter. So that has grown incredibly fast. It's taken a few people off guard. Our belief is that facilities are now becoming structural. There's lots of caveats coming. So for those that are worried about me being a kind of facilities mega fan, I think they're taking over the world. They are becoming structural. If you just look at the level of investment that brokers are putting into them, they're investing far above what we would do if it was just purely let's get this in for kind of a few years and see what happens. But I think the rate at which they've grown has been a cyclical, has been a feature of the cycle.
Well, why would you say that they are? So what's different now for this to become structural? Is it technology again, or is it something else?
There's a bit of technology. From a broker perspective, they've started to crack the historical challenge of indexation. And what I mean by that is a placing broker doesn't need to use a facility, and a client doesn't need to accept risks. They're part of their risk being placed through a facility. They can say, no, I don't want to do that. And that's correct and proper. But what they have worked out, the brokers, is they've worked out a way of embedding it in the workflow of the placing brokers and helping them engage their clients on it. So it's seen as valuable, it's seen as efficient, effective, allowing the brokers to spend time on where the clients value it more in terms of understanding the risk, spending time finding true leads that genuinely drive value. And that, if you start to crack that, the indexation bit, which is making sure that you provide enough of a spread of risk across the market so it's representative of the market as a whole, rather than just being the stuff you can't place anywhere else, which has been alleged of some previous endeavors of some of the brokers, then actually people know what they're getting into. The underwriters know what they're getting into. The clients and the brokers, placing brokers, see it as valuable, and therefore it's then embedded in the system, and people are just used to using this. And from everyone's perspective, if data starts to flow, to your point about tech, whereas a tech enablement, suddenly everyone's going, actually, you know what? Within reason, this is beneficial to the market if well managed and good oversight from Lloyd and syndicates, etc. Then I can see it remaining. It's the reason it's accelerated so much, and arguably why it's such a big chunk of the market. I mean, people are talking about a 30, 40%, if you add up all of the different types of facilities, is a cyclical thing. Do I think it will massively drop off? Yes, no. Do I think it will grow at this rate continued? No, absolutely not. And do I think, in a hard market that change a bit? Yes, but I think it's fairly well embedded. There's one caveat to that, is that in this market, very people-driven, if there's a kind of perceived catastrophe, and I don't mean just a hurricane, I mean like a facility doesn't perform well, is perceived to perform really badly, that could change everything.
So you worked with a significant portion of the market, and you obviously advise. So I guess specifically at the back of this report, but more generally, they come to you and say, "Hey, well, are we doing enough? Are we working on the right things?" I guess it's quite difficult to provide like a themes across the whole market. But if you had to say like, what are your main recommendations of where markets should be focusing on right now and getting it right in the next 6 to 12 months?
Yeah. So, I mean, I think fundamentally everyone needs to be managing the cycle very, very carefully, both in terms of not kind of dragging it down, obviously, but also just being very thoughtful about where you write business. And a lot of people we're talking to are thinking about it carefully, and it's just a case of putting that really concerted effort in. We help a number of clients think that through, think a bit more on a portfolio kind of allocation basis, thinking about their strategy in terms of where do you place your bets, thinking about more about capital rather than necessarily just focused on kind of underwriting performance per COB, looking at broader market trends. Not everyone has done that. Some businesses are much more structured around the lead underwriters are in charge and then you add everything up. So we're helping people think a bit more top down. Think about it and thinking about things as a segmented model. We talked about that before, being really laser focused where you're going to play and where you're not. Digital lead, for example, it's absolutely acceptable for some people to say, this is not for us. We're a true lead, open market lead. That's what we do. We're not going to play in that space. We're not going to distract ourselves. Being really clear about that. And within that, therefore, what is your proposition? Lead proposition, follow proposition. And what is your operating model? How do you structure yourselves to deliver on that strategy? Fundamentally, in a softening market, competition is much greater. You need to have an edge over your competitors. What is your edge? How do you deliver your edge effectively? And then there are just a few other bits that hang off that in terms of, firstly, AI. You need to think carefully about that. In our view, it's not a standalone thing. It's a part of your business. And therefore, you think about how you embed it in your business today and over time, whether you want to be a leader in that space, whether you want to be a fast follower. There's a bit around processes. This is not just shifting from being a true lead to being a capacity leader isn't just tweaking some processes. It's fundamentally, you mentioned this a few times, thinking about your operating model. And then in terms of the technology, becoming much more open to being interconnected. I've been saying this to people for a number of years. The London market tech stack was originally designed as a record keeper. Can I log a policy so I know what I'm underwriting? Me know what I'm underwriting. and therefore people typing stuff in, it's saved somewhere. It wasn't designed for the modern age of interconnectivity. There's a bit around your, like, reach out to different data systems, gathering kind of cat data, whatever it might be, weather data, marine data. But over time, it is going to be a much more integrated system, brokers connected to carriers. And the CIOs and CTOs need to think about that really carefully, because they are predominantly sitting on tech not designed to do that. I mean, those are broadly the things. And actually, one last point, be really clear, it's not just about expenses. This is not.
It's not about, sorry, say it again, Ref.
It's not just about expenses. This is not a pure expense play. This is a business strategy, a proposition, a market positioning, a competitive edge play, of which expenses is a part.
One of the things that I see some people defaulting into is they think about, when they think about this lead follow model, they think, well, lead is about fully human underwriting. Follow should be much more of like an automated AI-driven model. And we would love to get your thoughts, because obviously, I think your answer is going to be it's not that black and white, which I would fully agree, which I fully agree, right? But I think and perhaps two reflections, and we would love to hear your thoughts. One is on the lead side of things. Even when you lead, if you look at the size of the risk in the London market, there's always the 80-20, right? So 80% of them will be reasonably more homogeneous, smaller risk, and 20 very real complex ones. So even if you're a leader in that line of business, how do you adapt to those two types of different risks? So challenging, it needs to be human underwriting, but I'm also challenging the opposite, right? It's like, if you're a follower, if you follow it, should it be fully automated or not? So what are your thoughts on that?
Yeah, a few observations. We've done a lot of work with clients on codifying underwriting rules, and it's much more than you would expect. The number of times you sit in a room, an underwriter says, well, no, you can't codify my experience. 2 hours later, you have a very simple spreadsheet doing a 90-10 on the risks that come in. Now, there's lots of other reasons why that becomes hard: data flow, timing of data, all that type of stuff. But fundamentally, there is a lot out there where this myth of expertise is a myth. Now, am I saying that the London market is living on a myth? Absolutely not. There is genuine expertise. And actually, one of the things we find particularly interesting is that what people think they do when they underwrite and what you codify doesn't always end up being what they actually do. And actually what they actually do is better. So there's obviously a learning cycle in that. So in terms of digitization, I think certainly there's certainly much more that can be digitized than people are willing to accept. There's a cultural aspect. You've been trained to scrutinize things. You've been trained anything crosses your desk, you look at it and you understand, you put your expertise in. Again, do I think structurally the Lloyd's market, London market has an issue? Nope. But I do think there's the tide is higher than people, can be higher than people think it is. So that's in terms of the digitization piece. In terms of the AI aspect, I think there's a real exciting opportunity here, which might sound scary to some, but I think it's just thinking about how the world is evolving. What underwriters really add value in is, particularly in the London market, they were known for bringing a risk. I mean, historically, bringing a little scrap of paper with a few words on it, someone look at it, sniff it, and say, yeah, I'll underwrite that. And the speed at which you could pick something up that other people wouldn't touch because they're like, I don't really understand that at all, was hugely valuable. And I think what I'm excited about I'm going off track a bit, but what I'm excited about in the Lloyd strategy is that they are getting back to the grassroots, like, why do we add value, rather than a kind of like everything should be straight through and there's a slight vibe from previous incarnations. And I think what Gen AI has the capacity to do is to support the underwriter in being able to absorb huge amounts of information. So when that scrap of paper comes across their desk, they can sniff test it. They can use their experience and then augment that with a huge variety of data from other places to make better decisions. To your point, to triage out the ones that either they don't need to look at, or the ones where actually, you know what, you never underwrite this type of thing. It's got this particular bit in it. You just don't touch it. Or by the way, looking at the claims performance, you should never underwrite this piece of thing because actually this type of thing, because it's not great. And allow them to spend the time where there is real value. And Gen AI can do that. Is it quite there yet? It's very close. The hallucinations are much less bad than they were. This worry that everything that is produced is just all made up is being dealt with. It's not perfect, but it's being dealt with. And I see that as a really exciting opportunity because you can do all sorts of things. You can reduce your minimum premiums because actually you can get through things much more quickly and focus on where the value is. You can potentially expand your appetite a bit. You can improve the relationship with the broker because the broker knows 90% of things they're going to get within 10 seconds. They're going to get a notional broadly yes or broadly no. So I think that is a real opportunity. It's not here yet. So it's about the pace of AI. And I wouldn't want to be the kind of person that's scaremongering to say like everyone else has absolutely smashed it. But if you are assuming it's a way out, just need to think about that a little bit carefully.
One last question, just building on that, because the most players today are thinking about like, okay, how do they prepare their workflows, technical architecture for that future you are describing, right? And I think one thing I see is, I think that there's a risk that in this world of AI, we are still building workflows that are human first, right? So how do you advise your clients in thinking, okay, well, most likely for the next months or whatever period of time, you still, as you get more comfortable, you still want an underwriter to sniff test or to look at every risk, but over time, the trend you cannot negate. It's gonna just it's going to increase the automation. So how do you think about how they should be thinking about I'm at a very high level, that's their technical architecture?
Well, there's the business architecture and then there's the technology architecture. So fundamentally, AI will over time shift the way that people think about technology architecture. At the moment, technology architecture is predominantly structured around processes and around human-led processes, fundamentally. Actually, if you look at genuine kind of pure end-to-end automation within kind of services-based businesses rather than product-based businesses, there is a huge amount of, actually, a lot of it is about decision-making. And what generative AI can do is help make decisions. It's not just about automation. It's not just about taking a boring process and doing it quickly and with a computer and ideally more accurately. It can make decisions. It can make choices. Again, are we there today in a way that you would just let go without thinking about it? No. Are we getting there rapidly? Yes. So one thing is around the technology architecture is actually the technology architectures will shift to being process aligned, to being decision and capability aligned much more so. And that is a very different architecture from today. And I'm very conscious that people are they're not even starting in today's world, they're starting 2 generations back, mostly. So not only do we help people look at where the future is, but go, okay, but where are you today and how do you get there? Because it's all good and well going, the future is bright and exciting. Fundamentally, you've got a journey to go on. And then I think in terms of the business context, it's that real balance again of where do you believe it will get to and how do you get there? And in the short term, it is fundamentally give people safe confidence that actually this is positive, it's making good decisions when you give it the right inputs, and allowing people to progress as a business so that they trust and value rather than fear, which is a lot of where certain parts of the market have started on. It's like, this is hallucinating and taking my job.
Greg, this has been a fascinating conversation. I leave this discussion thinking one is very clear message of every player should think about what they lead, what they follow, what type of lead and follow they are, and then think how that cascades down to the business architecture and operating model, and then to the technical architecture, thinking about how do you align your technology to those capabilities rather than just trying to do a better version of the human processes today, which I think it's a great food for thought, and I'm sure many CIOs, CTOs are thinking about this at the moment.
Yeah, and you'll see that, I'm sure, in your conversations with your clients, right? It's kind of like,
Exactly.
can I take this human thing and just slot it into what we do? It's like, well, actually, if we just pause for a moment, we can make this better for everyone.
Exactly, but you're right. It's like they are still dealing with architecture that are 2 generations ago, and they are thinking about how do you leapfrog these generations to build something that is fit for purpose for the next 5-10 years. And I think obviously that is nothing. I mean, that is something that requires a lot of discussions within the industry.
Yes.
But with that, all I can say is thank you so much, Greg, for joining me today. I thoroughly enjoyed the conversation.
Well, thank you very much for the invite. Appreciate it.